Welcome to Hydrogen Rising, a bi-weekly podcast created and hosted by the global law firm K&L Gates that brings you analysis of critical, cutting-edge issues impacting the global hydrogen market. We look forward to your engagement and feedback. And of course, don't hesitate to reach out if you have ideas about new topics you'd like us to cover.
Hello, everyone. My name is David Wochner, and I'm a partner in the Washington, D.C. office of the global law firm K&L Gates, and happy to be with you again for this time for episode 6 of our very popular podcast, Hydrogen Rising. As our regular listeners will be aware, one of the recurring topics on the podcast has been the appropriation by multiple governments around the world of government-backed financial incentives for clean energy, and particularly for hydrogen. Of course, national governments recognize the important role that development of green or blue hydrogen can play in transitioning to a low-carbon future and in meeting international and domestic obligations, for example, the Paris Climate Agreement. And Australia is no different in this regard. The federal government has committed approximately 146 million Australian dollars. That's roughly 110 million US to the industry since 2015, and has committed an additional 370 million in funding through various agencies. So today we're going to be focused on what's happening down under. Very excited to be joined by my K&L Gates partners, Clive, Cachia, and Betsy-Ann Howe from our Sydney office. Betsy-Ann serves as practice group coordinator for our global tax practice, and Clive is a partner in our energy, infrastructure, and resources practice area with a focus on corporate transactional matters related to energy project development. So, Clive, I'd like to start with you. I understand that there are two main federal government mechanisms for hydrogen industry currently in terms of investment. The Renewable Hydrogen Development Funding Round, established by ARENA, or the Australian Renewable Energy Agency, and then the Advancing Hydrogen Fund, administered by the Clean Energy Finance Corporation. I guess as an experienced projects lawyer, can you lay the groundwork for our listeners in understanding the basics of these incentives for the hydrogen industry?
Thanks, David. Yes, generally that's right. So let's break these into two discussion points because the means and the focus of the two separate agencies are different. Firstly, ARENA's Hydrogen Development Funding Round aims to provide funding of up to $70 million to support at least two projects that involve the deployment of a new build electrolyzer as part of either a brownfield or greenfield project for the production of renewable hydrogen. In July of this year, ARENA announced that 7 companies had been shortlisted to advance to the full application stage of the funding round. All shortlisted applications have well-developed projects that involve deploying 10 megawatt or larger electrolyzers made up of various end uses, including transport, gas injection, renewable ammonia production, power, and industrial use. The projects seek $200 million in grant funding in total towards a collective project value of almost $500 million. ARENA grants awarded to activities under the program are expected to be between $100,000 and $50 million, with applicants typically expected to at least match the funding being sought from ARENA. In the short term, applicants must submit their full application by January 2021, next month, and successful applicants will be issued a non-binding offer to negotiate a funding agreement expected to occur in mid-next year. And the funding agreement will set out the legal framework for the obligations of each party and, of course, the terms around payment. Now, the funding provided through the program will generally be in the form of grants, which includes recoupable grants, and that's where some portion of the grant may be required to be repaid if certain conditions are met in accordance with the funding agreement.
Thanks, Clive. I take note of the date that the applications are due, the 20th of January, which of course is the day that the United States will inaugurate its new president. I hope perhaps that will begin our path forward on finding real opportunities for investment in hydrogen and incentives for hydrogen. So what about the second kind of main incentive program, the Clean Energy Finance Fund?
Yeah, so the CEFC's Advancing Hydrogen Fund will draw on $300 million of existing CEFC finance. And through the fund, CEFC expects to provide either debt or equity finance to eligible large-scale commercial and industrial projects, typically requiring $10 million or more. The CEFC may invest across various capital structures, including publicly traded or privately held instruments such as senior debt, subordinated debt, preferred equity or convertible debt, common equity, and also by way of royalty or other production-based payments. At this stage, the funding is limited for concessional loans by a portfolio limit of $300 million in net present value terms per annum, and in respect of guarantees provided by CEFC by the actual portfolio limit of 5% of the total amount invested with CEFC by the Commonwealth. There's a few other interesting things to note. CEFC investments typically include co-financiers or equity partners where possible. The investments are made with the expectation of a positive risk-based financial return, and hence concessionality is applied sparingly on a case-by-case basis. And for smaller scale projects, that is those seeking $10,000 to say $5 million in funding, may be eligible for debt finance through CEFC's specialist asset finance programs. Now, for these smaller scale projects, CEFC investments are made via wholesale debt facilities provided to co-financiers, who then use the capital to provide low-cost finance to borrowers investing in smaller scale clean energy assets around the country.
That's helpful background. Thank you for that. And I think, Betsy-Ann, if I could turn to you, obviously a lot of excitement in Australia around the hydrogen industry. As you know, I practice in the liquefied natural gas space, and Australia has had a huge role to play there globally. I expect, similar to LNG, with hydrogen, Australia is likely to see substantial inbound foreign investment. And I expect that the incentives that Clive just talked about will be attractive and lure in investors, both strict financial investors, but also, actual energy operators. A major element of any large investment like this are the risks posed by taxing authorities. And so, since we do have listeners around the globe, I think it would be helpful if you could, highlight for our listeners some of the tax considerations that investors in the Australian hydrogen sector should be thinking about.
Thanks, David. Yes, I think it's right to say that Australia relies very heavily on inbound investment into its large infrastructure projects and increasingly into renewables and LNG and other areas. As with any investment from offshore, tax should not or will not drive the transaction. But if the tax treatment for the investor is not conducive to ensuring that they're getting a reasonable return on their investment, then generally the investors will look elsewhere. In Australia, we have a federal and state system of tax, very much like you have in the US, and both need to be considered in determining the tax impost on the investment. We have seen in recent years very significant investment from the US, particularly from US pension funds, state pension funds as well. And this area historically had been one where we were seeing a reasonable number of exemptions available for returns in the form of interest or dividends and certain what we call managed investment trust distributions. And the normal rate on any investment in Australia, or the tax cost, will be around 30%. But in some cases, the rates for foreign pension funds and for sovereign funds can be zero on interest and dividends and 15% or 10% in certain circumstances. So the structuring piece around the investment is really quite critical to ensuring that you are paying, the least amount of federal tax that you have to pay. Australia is a relatively high taxing jurisdiction. It does, as I said, have a rate of 30% at the federal level, but that is reducing down to 27.5% at the moment, and that's expected to come down a little bit further. Nonetheless, it's still a significant tax impost, particularly for sovereign funds which pay no tax in their home jurisdiction, or US pension funds who similarly are not taxable in the US. So what I guess the important takeaway in relation to tax in Australia is that the structuring of the investment will be really critical for an offshore investor. Whether they come in by way of debt or equity will impact very significantly on the tax impost on their returns. What we are seeing in recent times is much more of a focus on debt coming in from offshore, and the reason for that is two reasons, I guess. One is our Foreign Investment Review Board generally does not have to approve debt-type funding into Australia. But secondly, that the tax considerations generally will be much more attractive. So these sorts of things will drive the structure. And I think the important thing is just to remember that the tax structure, once put in place, is very hard to change, as it is in any jurisdiction. So upfront focus is very, very important. I will also just mention that in addition to our federal taxes, We do have state taxes, which are primarily stamp duty transfer type taxes involving acquisitions or transfers of land or interest in vehicles which hold land. Those costs vary from state to state, but by and large will be around the 5% mark on the acquisition value. And so that can be a very important thing to structure around also to ensure, firstly, that you're not paying two lots of that tax, which is one of the real traps for investors, but also importantly, the timing around the payment of any of that, particularly where you've got a project which is going to take some time to complete.
Two things you said that were particularly interesting for me, and both perhaps the topics of future podcasts, but one with regard to state pension funds out of the U.S., which, of course, there's significant focus now on sustainability in investment. And so, green hydrogen as a potential investment vehicle for those types of state pension funds, I think is a huge issue. You also referenced FIRB, which for U.S.-focused listeners, that's the equivalent of our CFIUS in the United States. And that to me is something that I think is, as investment really begins to open up and flow globally into some of these new major projects, I think that foreign investment review process, whether the US or Australia or the UK, Canada, is going to be quite relevant. So put a marker on the table for those as future conversations on the podcast. I guess, Betsy-Ann, just a little crystal ball gazing for you. As you look to the next year or two, what, from the tax vantage point, what do you see, or do you see the Australian federal government taking any particular actions that could promote the hydrogen industry or promote investment?
Yes, so in Australia, we find that the federal government in particular does not tend to use tax as an incentive for particular types of investment. So you find that you don't get tax concessions really into particular industry sectors. And we have some minor ones, I guess. We have it into clean buildings, for example. There's a lower rate of withholding tax for offshore investors if they've invested into a fund, for example, that's owning clean buildings. But really that's sort of the only type of thing that we have tended to do. I don't see that changing over the next period. I think we may see more focus on increasing the R&D or research and development incentives, which are very tax-driven and which have had a long and slightly difficult history in Australia. Successive governments have changed and rechanged and changed back. But right now, our R&D incentives, I think, are generally viewed as good as they have been in some time. They are, difficult to fall within, and I think we might find that there's some further guidance and assistance that the government will provide in relation to those. And then I think the other area is generally that around the piece we were talking about previously. So the super funds, the offshore super funds, the offshore sovereign funds. We are suffering from a little lack of clarity around treatment of those. And I can say that from experience. I've got 4 rulings in with our Australian tax office at the moment, various US pension funds and sovereign funds. And it's fair to say that the consistency levels are not great. So I think we're going to see some tightening up of the ATO's approach to some of these sorts of important rulings, because obviously the ATO, while it interprets the law, it shouldn't be setting policy. So our tax office issues private rulings for parties which, are then binding upon the tax office. So I think a lot of offshore investors do like to go down that route, but that process needs to be much more efficient and much more streamlined, I think, to provide the certainty around tax treatment for offshore investors.
Thank you for that. And that certainty is important. We actually talked about that in episode 4 when we were talking about storage of hydrogen and the need for certainty for the investment to flow. So I take that point. Clive, I guess, close out with you. Similar to what I asked Betsy-Ann, do you see particular, if you look into your crystal ball, do you see the government taking any particular additional actions in the incentive space, to further incentivize the industry?
Yeah, I think the current incentive programs, which we just went through, will be maintained and embellished, at least in the short term, without any radical changes. It's been successful in recent times, and that's demonstrated by the fact that there have been a number of high-profile and existing projects announced in recent times. And a couple that stand out are Firstly, the $496 million pilot project in the Latrobe Valley in Victoria to convert its abundant brown coal reserves into hydrogen and then transport it to Port of Hastings for liquefaction and then shipping in a world-first purpose-built liquefied hydrogen carrier to Japan for use in fuel cells and power generation. It's being developed by a consortium of various Australian and Japanese companies, including Kawasaki, Marubeni and AGL, and it's co-funded by both Australian, Commonwealth and Victorian governments to the tune of $50 million each. Another interesting project is Fortescue's announced development of a 250 megawatt green hydrogen production facility in Bell Bay in Tasmania. It proposes to produce ammonia for both export and domestic use. And the development has a planned production capacity of 250,000 tonnes of ammonia and is due for final investment decision by mid-next year. And then also interestingly, Origin Energy is also conducting feasibility studies, this time partly funded by the Tasmanian government directly, into an even larger green hydrogen production plant, also at Bell Bay. So at a proposed size of 500 megawatts, it would be one of the biggest in the world if it goes ahead by the scheduled start date of the middle part of this decade. So you can see these projects and others have attracted preliminary government support and funding, and we can expect such support to only increase as these project developers progress their feasibility studies and get closer to final investment decision. So state governments in Victoria, Tasmania, but also other state jurisdictions like Queensland, South Australia, WA, and New South Wales, who have recently released their hydrogen roadmap, have all launched incentive programs to either directly support these hydrogen project developments or indirectly support proponents to access the Commonwealth funding via ARENA and the CEFC programs we talked about earlier.
Fantastic, Clive. This has been, I think, a great conversation. I'm very appreciative to you both, Betsy-Ann and Clive, for joining me. There's so much buzz right now about hydrogen globally, and I think Australia is on the leading edge of that. So I expect this will just be the beginning of our conversation. Thanks, of course, to our listeners today for joining us. If you like what you hear on Hydrogen Rising, don't forget to subscribe wherever you listen to podcasts. And of course, click those 5 stars in your podcast app. If you have questions about the issues discussed today, please reach out to us. You can find all 3 of us, me, Betsy-Ann Howe, and Clive Cachia, on our website at www.klgates.com. And of course, stay tuned for the next episode of Hydrogen Rising in 2 weeks.
Thank you for listening to this episode of Hydrogen Rising. Be sure to subscribe to receive timely notifications of future episodes and check out our market-leading publication, The Hydrogen Handbook, on our website at www.klgates.com.